Thanks for joining our Reliant Fund Services monthly WebEx. I'm Eric Schultz. I'm the managing member at Reliant, and this series is all about bringing emerging managers the real world conversations you actually need, not the generic, high level stuff that you can find anywhere else. Every month we bring in someone who sees the inner workings of of early fund builders, the real pain points, the blind spots, and the questions no one wants to admit that they don't know the answers to. We are very excited to be joined today by someone with a generally rare vantage point in this space, someone I personally work closely with across many mutual clients, and someone I trust deeply, Vanessa Sasson. So Vanessa is a partner at Florio, Leahy, and Orical LLC. That dual role is incredibly unique. She sits at the intersection of fund formation and compliance execution. She sees both the legal and operational realities of what it takes to grow a first-time manager into an institutional-grade firm. She advises on hedge funds, private equity funds, venture, real estate, private credit. I mean, you name it, she's done it. And she works with hundreds of emerging managers every year, especially those crossing that 50 to 150 million range, where all the pressure points start showing up. I'm constantly, me personally, I'm constantly getting these questions from emerging managers in our ecosystem. And Vanessa is the perfect person to demystify all those questions. So today we're digging into the questions every manager eventually asks, usually at 11 p.m. the night before a fundraising call. Okay, Vanessa, let's jump in.
Thanks so much, Eric.
Yes, thank you. I'm so happy you're here, and I'm excited for this because I know I'm constantly being asked these questions, so I know you're going to demystify everything.
I will do my best.
I know you will. So let's start with the question every emerging manager thinks they know the answer to until they don't. Yeah. When does the SEC become relevant?
Sure. So I think probably many emerging managers think at the $100 million mark, it becomes relevant. But the truth is the SEC comes into play well before you hit $100 million in assets under management. Prior to meeting that regulatory asset under management threshold, they care about how you market, what you're saying to prospective investors, how you're presenting your performance, your track record to date, how you handle and how you disclose conflicts, and how your vehicles are structured. So all of these things come into play, and the SEC very much cares about them, regardless of your assets under management.
So now let's get into another question I probably hear more than any other. And every manager basically gets a different answer depending on the AUM that week. What's the real trigger point for registration?
Sure. So I feel like any lawyer, I'm not going to give you a total straight answer on this one because
I wouldn't expect anything less, Vanessa.
It is complicated, but I'll do my best.
Thank you.
I think a lot of managers don't realize that there's two frameworks for registration. There's state registration, where you have to look into the rules of the road and the state in which you make investment decisions from. And then there's a federal framework, SEC registration. As a general matter, when you manage less than $25 million in assets under management, you are exclusively regulated by the state in which you make your investment decisions from. I'm based in Manhattan. If I'm going to become an investment manager and I manage less than $25 million in assets under management, I only have to look to New York investment advisor laws and see if I need to be registered or if I'm exempt from registration. Some states may require me to be registered with that amount of assets under management. Some states may say, oh, regardless of your assets under management, if you have more than 6 clients, you need to be registered with us. Each state has their own set of rules and regulations that you have to look to. So that's below 25. When you have over $100 million in assets under management, you've got to look to SEC and federal laws. So, but that leaves you with this awkward range, right? What happens between 25 and 100? And that's where you need a sophisticated regulatory partner to help you figure out what status do you need, what's the interplay between state and federal requirements, which one is most favorable for your business. It's probably, it might be surprising to some of the participants on this call to hear that you actually want to have you probably want to have a status with the SEC before you have a status with the state. In many ways, it's much easier to comply with and understand the federal obligations. So I know that was a long-winded way of answering your question, but as you see it, it is quite complicated.
Yes. It's funny. I always say lawyers talk in lawyerish, not English. And you have your own separate, language. Even.
Just to defend like that, I guess if there was a takeaway, if someone heard this question and needed the takeaway, the trigger point for registration is based on a mix of how much assets under management you have, where you're based, what kinds of clients you advise, funds versus managed accounts. So you got to analyze all of those, and then we can make a decision.
It sounds like managers really need to see you even before 25 million, because it's just so confusing. And I'm sure it's like they don't know what they don't know. And the last thing you want to do, I'm assuming, is trip up a New York State law, California, or a federal. So, I would think that emerging managers really want someone from day one, at least looking at, giving them guidance as to, when they hit certain milestones.
Absolutely. I can't tell you how many prospect calls I have with an emerging manager that has no need for any regulatory status. I have a quick call with them. It's half an hour. I feel like they're happy with the results I give them, and then they call me a year later when they have way more assets under management.
Yeah. Okay. So the next question gives me personally heartburn. RAUM.
Yes.
How should managers think about RAUM across SPVs and co-invests?
Yes, good question. So RAUM, regulatory assets under management, is different from what a lot of the participants on this call might think of in terms of their AUM, assets under management. What everyone should know is that regulatory assets under management, which are these thresholds we're monitoring for, are calculated on a gross asset basis, not net. So leverage is counted, unrealized appreciation counts. If you have an underlying portfolio company, right? You're a private equity fund manager or venture capital fund manager. Your portfolio companies are doing great, right? They get revalued. They went up in value a lot. That alone could put you past the $100 million threshold, even if you didn't raise nearly $100 million in terms of capital commitments from your investors.
I mean, sorry, continue, please.
I was just going to say, and you also have to look to the various vehicles that you advise, right? A manager may think, hey, I've just launched my first commingled fund, and only look to the RAUM of that vehicle. They forget, hey, if you had 3 historical SPVs before this, true commingled fund, we have to count those as well as co-invest vehicles.
And RAUM, I believe, also includes uncalled capital, right?
Correct.
Right. So that's scary, because if you have some SPVs and you raise a $70 million fund and you're thinking, oh, I haven't deployed it yet. No, you still have to include that 70 million.
Exactly. And so while managers may actually end up tripping that $100 million threshold earlier than they realize, which would of course have regulatory implications and increase their regulatory footprint, I'd say the flip side of that coin is it's pretty great from a marketing perspective. Right. They're actually larger than they necessarily thought they were.
Okay, that works. So let's say someone actually bites the bullet and files Form ADV with the SEC. Now what? Yep. Does the SEC send a fruit basket, a welcome letter? What changes after you file that Form ADV?
Yep. So if you're filing a Form ADV to apply for registration with the SEC, right? Assuming you can't rely on an exemption, which could be which we could discuss later, or it could be a whole other.
Yeah, that's another lawyerish answer, I'm sure. But yes.
But assuming you're filing the Form ADV and you're saying, hey, SEC, I'm applying for registration. I'm a big boy now. Let's talk shop. The SEC will have 45 days to approve or deny that application. In our experience, they almost always approve it around day 30. And as soon as they approve that application, that Form ADV, you are required to comply with the Advisors Act. And that means that a lot of things get more serious. You've got to have a chief compliance officer, for example. All of your funds must now receive annual audited financials. You have books, you have pretty onerous books and records keeping requirements. You may, people on this call, you may have heard of your peers in the industry having to archive their text messages or stopping texting with their colleagues or their clients because they don't want to archive their text messages. So I feel like those are some of the big things that change. Of course, there's a lot of compliance protocols that come into play. You have to have policies and procedures. You have to do annual testing, training, quarterly code of ethics reviews. There's a lot that comes into play once you're registered. And of course, what everyone is nervous about but should expect, because it's natural, is you will get examined. It's not a matter of if, it's a matter of when. The SEC is fairly easy in terms of approving your application for registration, but the way in which they come back and kick the tires and make sure you actually should be registered is by conducting periodic routine examinations.
I mean, so basically, once you file, I mean, if you didn't have someone like you before, well, first of all, they need someone like you. They need you to help them file in the first place, right? Because I'm assuming
Yeah,
Form ADV is a complex, form.
yeah, that's right.
And um, so, generally, how far in advance should managers prep? Do you think?
Sure. So I think anywhere from 6 to 9 months is probably ideal for a clean, low stress lead up to the registration process, right? You can work with your fund counsel, you can hire a compliance consultant, you can introduce those people to your fund admin, kind of get all your ducks in a row.
Mhm.
Um, Conduct an enterprise risk assessment, figure out what policies and procedures are actually going to be appropriate for you, right? We know what policies and procedures an RIA, a registered investment advisor, needs, but those have to be appropriate for your business. What I would advise a hedge fund to adopt, hedge fund manager to adopt as a personal trading policy is very different from what I would advise a private equity fund manager to adopt. You can use that time to fill your marketing gaps. If you've been saying things that may not totally comply with the marketing rule, now's a good time to clean that up. You can get your team familiarized with what being registered actually means, conduct a training, get them used to starting to report their personal brokerage account activities. So I think at least 6 months is a good lead time to get a firm prepared to be SEC registered. You don't want to do all these things right after you submit that Form ADV.
I mean, it sounds like you need a year and a half. I mean,
No, no.
I'm joking, but the amount of time and thought, I keep constantly hearing people that are about to register. I gotta get, I can't use WhatsApp. I can't use this because because of the SEC, right? And so you really have to have your ducks in a row, like you said.
Totally. And like I said earlier, I love to speak with managers as early as like launching their first SPV in their investment management career, because maybe I can help them and give them tips and help structure their business so that they could actually remain exempt reporting advisors for years to come. There's lots of actually exemptions that managers may be able to rely on that could take them, if even if they manage more than $100 million in assets under management, the SEC does provide for a couple of exemptions that you may be able to rely on. And if I could help a client, come up with that sort of uh, favorable, lighter touch regulatory framework, I know that I'll be on their good side for a long time.
What you said also resonates with me because as a fund admin, we always really want to get in from day one and help them, grow their practice, their back office from the start. And so I totally understand. You really want to get in there day one and kind of set the stage for the next, 2 to 3 years for them.
That's right.
So you had mentioned marketing. So I think of marketing as where managers accidentally create exam findings in their pitch deck. What are the biggest mistakes that marketing mistakes that you're seeing?
Yeah. The SEC loves to go after managers for being misleading or potentially fraudulent in their marketing materials. And they go after managers, like I said, registered or not. So you could be, have a really de minimis amount of assets under management, or you can have billions under management. The SEC looks at you the same way from a marketing
Mm.
perspective. And why is that? The SEC wants to know, what are you saying to prospective investors to convince them to wire you money? Right? Are you selling them a bag of goods? Or are you giving them, the full picture, and you're clearly disclosing risks and conflicts and making clear that this isn't promised performance, but this is targeted performance, and it's based on various assumptions, and these things could change tomorrow. And it's important that you get all those disclaimers in there, and you're very careful about the language that you use, because otherwise the SEC can come back and say that was a fraudulent sale of securities that you made when you were selling and limited partnership interest in your fund. I'd say the things that you need to be particularly careful about are the presentation of gross performance without accompanying net performance. Why?
Mhm.
Because what does the investor actually achieve? The net
Yeah.
performance, not the gross. Track record portability, they really care about. If you are a manager that previously worked at Millennium and you were part of an investment team, there's lots of rules of the road on how you can port that performance. Can you? Were you the decision maker at the prior firm of that, track record at Millennium, or were you just one member of a team? And so we need to think through these things and very carefully disclose them if you want to use a track record from a prior firm. I'd say those are the main ones that come to mind as marketing risks.
Do you have any? Do you happen to have any examples you could think of what how the SEC got you know kind of went back to a manager and said, we found this,
Yeah,
something like that?
yeah, definitely. So first of all, I'd say in almost every exam that I go through with my
I'm sure.
clients, the SEC asks for the last 2 years worth of marketing materials. So they are looking to dive in and find things that are wrong. Um, so we hand those over, and one example that I saw recently was a private equity fund manager had like a really brief line that said, we invest alongside best in class or world class management teams. Like,
Hmm.
they were trying to say, we invest in portfolio companies that we believe are led by best in class management teams. I know that's
Right.
what they were trying to
Seems
say.
normal. Yeah.
But the SEC said, you didn't say we believe are world class management teams. You said you invest alongside best in class management teams. Prove it. You have a duty to substantiate everything you say that's material in your marketing materials. And that's a material statement. So substantiate it. So we spent some time, gathering the track record of the portfolio companies in which we've invested and the bios. And we presented that to the SEC. But I thought that was such an interesting
It's
sentence that
subtle.
I could see people glossing over, right? But they
Yeah.
didn't.
So subtle. Like, I mean,
Yes.
they're really going after like everything. You have to be careful.
I think like one thing that people should remember is, as much as in the private fund universe, your pool of investors are quite sophisticated, right? They need to meet the accredited investor, qualified purchaser standard. You're not dealing with retail investors in the private fund space. It doesn't matter. The SEC looks out for investor protection. So they are looking out for investors whether or not they are, that higher level of sophistication. And they think that claims and marketing materials are have the potential to be really misleading, no matter who the end investor is.
Hmm. So another topic about with everyone's on social media these days. So like social media, website, testimonial, like how do managers, how can they navigate what they are allowed to do, aren't allowed to do? Just curious.
Yeah, I mean, look, obviously, I think the short answer is anything you post to the public on your website, on a LinkedIn, probably run that past your compliance counsel or your compliance consultant or your regulatory counsel. But whatever you say in the public sphere has to be even more sanitized than what you say in like a tear sheet that you share with a prospective investor, because you don't know who's viewing your website. The whole internet has access to view your website or view your LinkedIn. It's a broader universe, and again, more of a chance to be misleading.
All right. I mean, again, I mean, they have everything that goes out the door obviously needs to be reviewed by somebody.
Yeah, I think that's important.
Okay, so let's switch gears a little. So, Form D and Blue Sky filing, can you explain what they are and how they fit into all of this?
Yeah. So when you are selling an interest in your fund, a limited partnership interest, you're selling a security. A sale of securities has to be registered unless there's an exemption that you can rely on. Almost every private fund manager out there relies on an exemption from registering the securities of its fund. The way in which you perfect that exemption is the filing of a Form D. It's a fairly simple, fairly short form that's filed at the fund level. I'd say usually fund counsel files it because it's just one of the checklist items in closing for a fund. But I think what a lot of managers forget is that as you admit new investors into your fund, you must analyze the state in which those investors reside and determine if a blue sky filing is required. A blue sky filing is essentially the sending of a copy of your federally filed Form D with the state securities regulator of the state in which your investors reside. Again, there are some state exemptions that you can rely on, but it has to be analyzed. And states take this really seriously. You don't want to get into an issue with a state where they find out you sold an interest in your fund to a resident of their state, but you didn't pay the blue sky filing fee to perfect that sale. It's usually a couple $100s per state. Of course, it does add up if you have to do a lot of states, but it's really important that someone stays on top of this every time you admit a new investor into your fund, because state regulators really don't give much grace or wiggle room here.
Hmm. So I'm sure people forget, right? You get a new LP and they're in Wisconsin, right?
Yep.
You would forget in a second that we have to file in Wisconsin now.
Yep. It's another, and again, these rules come into play well before being SEC registered. This could, if you have $1 million fund, these rules come into play.
Wow.
So it's really important to like get that framework of partners, working with you as a fund admin, working with a compliance consultant, working with regulatory counsel, someone that you can just have a sounding board, right? Even if you're not working with them on a full-time basis, to
Yep.
make sure it's like to know what you don't know. Have a partner that can highlight those things.
Right. Yeah, I mean, again, like you said, with $1 million, these managers have no idea what blue sky filings are, right? I mean, I barely know what they are, and I'm in the industry.
Yep.
So you talk to hundreds of emerging managers. What are the most common questions they ask you?
When am I going to get examined? That's probably the number one question.
And
I
the
say,
scariest, I'm sure.
I wish I had a crystal ball. I wish I could tell you, look, the SEC just came out this week with their 2026 exam priorities. And one of their exam priorities is focusing on new registrants, meaning advisors that have got registered in the last 18 months. That has actually been a consistent exam priority out of the SEC for as long as I can remember. They want to come in early and make sure you get things set up right early, right? So that they can do an exam. Hopefully it goes well. They know you have your ducks in a row and they don't need to come back for a few years. That's the best case scenario for everyone. So I tell my clients, you should expect an exam in your first 18 months. I do think that the SEC is right now, trying to recalibrate a bit. They do have some workforce reduction. So I think they are trying to figure out who are the appropriate people to examine, who maybe presents a higher risk right now. But the short answer is expect one in your first 18 months and then expect one every few years thereafter. The SEC says they try to examine approximately 20% of the RIA community each year. So one every 5 years.
I prepared tax for 30 years and I've worked with the IRS, but Just those three letters, SEC, scares the hell out of me. And I mean, I'm sure it does to everyone else, especially the emerging managers.
It definitely does, but I hope that I could give those clients like the confidence to say like, I know it's scary for you, and I'm not minimizing that, but like
Yeah,
I do this every day. I sit
right.
in SEC exam meetings every day, and I go to their office, and they come to my office, and we sit across the conference room together. I know how these exams are going to run. I know what they're
Right.
looking for. I know the words that you could say that are going to trigger something for them or going to calm them down. So I really like to sit side by my clients and coach them through these exams and have them go as efficiently and as smoothly as possible.
Mm. Obviously, makes the most sense. So, $1 million question: how do you help managers decide whether they should stay exempt or register?
Yeah. So if I can find an exemption upon which a manager can rely, I am not doing my job if I don't tell them that right away. Right? Like, because if they can keep that regulatory footprint small, which keeps them, much more out of the spotlight of the SEC, reduces costs, right? You don't have the you likely don't have the fund audit requirement each year, even though you may do it anyway. The
Yep.
books and records keeping requirements, you probably aren't going to have a full-time, full-blown compliance consultant. It is costly to get registered. It's a cost of doing business, but it's just a fact. So if I can help them stay exempt, I let them know the exemptions upon which they can rely. The two exemptions that managers can rely on, even when they have over $100 million in assets under management, is that one, they advise only venture capital funds, which is a defined term, and you've got to make sure each of your private funds fits in the definition of venture capital fund to a T. Or you only advise private funds and you have less than $150 million in assets under management. And that $150 million mark is measured as of December 31st each year, or whatever your firm's fiscal year end is. So if you can meet either of those, you can remain exempt for a very long time, so long as you continue to meet those exemptions, even though you may have more than $100 million in assets under management. I would just say that in my experience, I have seen some firms that are eligible to rely on one of those two exemptions, but choose to get registered anyway. Maybe an endowment won't invest with them unless they're SEC registered, right? Because it does provide this badge of credibility. So it really depends. It's a balance of institutional expectations, what you're comfortable with from a regulatory exposure perspective. But we help managers analyze and figure out if they can remain exempt for as long as possible.
You had mentioned something before. I just wanted to ask you about it. It doesn't matter if you're registered or not. Yes, if the SEC can still come after your marketing material. Is that correct?
Yes, yes,
Got it. So regardless of registration, you're always going to be under the SEC's purview for anything you're putting out to the market.
correct.
Okay. What do most emerging managers underestimate in this process?
I'd say how much is expected to change operationally. Hopefully, not much changes operationally when you go from exempt to registered,
Mhm.
but because you now have a spotlight on you and greater expectations, you've got to be almost optically perfect, right? You've got to make sure that the way in which you're striking your NAV, the way in which you're calculating your fees, reporting to your investors, allocating expenses, allocating investments if you have multiple funds, um, is is being done exactly as you've disclosed to your investors that it will be done. So, like you said earlier that we've worked closely together. One of
Yes.
the reasons that I love working with you so much is when I'm working as fund counsel and I'm
Yeah.
drafting offering documents and I'm drafting a step down management fee from during the investment period versus during the harvest period. I love running those drafts past you because I need to know, are you going to have a problem with implementing and charging the fees as I've drafted them today? Because I don't want to hear that it's a problem in 3 years from now You know what I mean? I
No,
need
I
to
get it.
clean up that language
I
and make
love
it
working
good
with.
now.
I love when we do that, because we can both see what how it's eventually going to look, and you really have to just fine tune to make sure you're writing what you really want to see the outcome show.
E- Exactly. And I can't tell you how much time the SEC spends ticking and tying the way in which fees are calculated, um, tying it down to the penny. There's staff accountants on almost every exam team. So they're going to look to see exactly what you said, how you said you're going to calculate it in your fund docs, and then look to see your operational practices and make sure you're doing that. So it's really important you have a smart fund administrator that gets your business. You have a competent auditor that speaks with the administrator, right? You have fund counsel that drafts your documents to be reflective of how you are actually going to charge fees or allocate expenses or allocate investment opportunities. It, I say to so many of my clients in the private fund world, it's not that conflicts can't exist, right? Or it's not that you
Yeah,
can't take certain actions. You've just got to provide clear disclosure to your investors. As long as you're clearly disclosing what you're going to do, you have a lot of leeway.
yeah. I'm sure people are afraid to disclose things because they think the SEC is gonna frown upon it. But like you just said, as long as you're disclosing it, it's really sometimes it's a non-issue at all.
Agreed.
So give everyone a picture of what SEC ready really looks like.
Sure. The filing of that Form ADV, applying for
Mhm.
registration, empowering and anointing someone with the title of chief compliance officer. Usually it's someone internal that has some other senior level role, like a chief financial officer, at least
Yeah,
at a lean firm to start.
yeah.
Um, adopting and implementing policies and procedures that are tailored for your business, right? The SEC is not going to want to see some template compliance manual you downloaded off the internet or from Chat GPT that speaks all about your hedge fund business when you're a private equity fund manager.
Hmm.
Um, I'd say a regulatory calendar that could be created by your compliance partner, right? Making sure that you're apprised of upcoming deadlines, whether it be internal testing or external regulatory filings, and just probably strong and consistent conversations with your fund admin, making sure you're calling capital in the way in which you say you're going to call capital, calculating the fees in which you say you're going to do it. If you're allocating an expense to your investors, being damn sure that that is an allocable fund expense. And if you're
Yeah,
going to
we're
do all those
constantly
things,
doing that. Yeah.
I think if you do all those things, you're going to be in pretty good shape.
I have a question. So, okay, let's just say I register and I recall you saying you need a compliance officer. Is that someone that has to be an employee of the company?
No, it doesn't have to be, but the SEC maybe expects isn't the right word, but I think you are best positioned if it's someone internal at the firm with the title and
Right,
someone that's relatively senior. You need someone that has some disciplinary authority, where if you don't report your brokerage account, like maybe you're not going to get your bonus at the end of the year. You know what I
right,
mean? Someone
right,
with some teeth to make sure that those policies and procedures are enforced.
right. But that person normally doesn't know what you know, right? They don't know the marketing rules. Like normally the compliance officer has to work with someone like you.
Definitely.
Got it. Okay, so it's not just hire someone and all your problems are gone.
Yeah, exactly.
And a lot of
And I
emerging managers can't afford a CC, a compliance officer, right? I
and it
mean,
would be ridiculous to expect that.
yeah,
But I think it presents really well both in institutional investor due diligence and on regulatory exam to say, hey, look, we're a team of 4 people. Like, we're not hiring a general counsel, chief compliance officer. We can't afford that right now. It doesn't make sense for us. But we've given the title to our CFO, who's amazing, who has the internal knowledge of how our firm works. Obviously, there's a lot of overlap between finance and compliance. But please know we've actually hired an external compliance consultant that is really experienced in this space. They partner with us. We have them on retainer. We call them at least weekly with questions. So I think that gives a lot of assurance to both institutional investors and regulators. We've seen it present really well.
Yeah, I have a, again, I said this in the beginning, you and I have a lot of clients and they'll just, I know they'll call you and say, okay, I know I think you work with them on an outsourced basis, hourly or whatever, however your engagement is, but,
Mhm.
they're worried about something and then they call you and they're like, oh, it's nothing, let us handle it for you. And, and so just having that person on like available that like you, that knows the law, that can answer your questions and get back to them immediately really gives them comfort.
Yeah. When we started this business, 15 years ago, um, my partners and the co-founders of the firm, it was intended to focus on the registered investment advisor community that
Right.
needed this heavy duty compliance support. And that still is the vast majority of our client base. But over the last few years, we've updated our model and we have a whole offering just for exempt reporting advisors that don't need that much,
Right.
right, on a day-to-day basis, but they still need a compliance partner that they can use as a sounding board, do some regulatory filings, and help them think through these issues in real time.
Yeah, and that's actually one of the reasons why I wanted to bring you on here because like no one really, a lot of these conferences, people just don't get down to the like what everyone actually wants to know. Like, what am I afraid of? How do I avoid the SEC? And that's really, one of the reasons why I wanted to bring you
Yep. Well, thank
on.
you for inviting me.
It's my pleasure. So one last question. So
There.
let's just say I'm a manager. I have 50 to 100 million. What should I be doing right now?
Well, clean up your marketing. Look what you're saying in your marketing materials. Because if you have 50 to 100 million dollars right now and you're putting a piece of paper in front of a prospective investor, it's very likely that that piece of paper is going to be in scope once you're registered next year.
Okay.
So clean up your marketing materials now. Um, Review your fund document language with respect to fees and expense calculation. Make sure it's accurate. If it's not, update it. Um, Collaborate with your admin to make sure they agree, right, with how those fees and
Yeah.
expenses are disclosed. And probably calculate what your true RAUM is so you're not surprised.
I mean that I would agree with that, especially when you have tons of SPVs. I mean, it gets lost.
Absolutely.
Well, I have to say, Vanessa, this was fantastic. I think everyone here feels a little more SEC ready than they did about 40 minutes
Good.
ago. I thank you for the clarity and for making something that usually feels intimidating actually feel doable.
Great. I hope that it worked. And I think it's important to remember that as scary or intimidating as some of this sounds, like registration is a privilege. It
Right.
means you've scaled, you've institutionalized, you've earned meaningful client trust to manage the amount of assets that you're managing. Like
Right.
it is a huge milestone, it is a victory. And so what matters now is you have thoughtful partners to guide you in this new realm that you're operating in. Thoughtful, business savvy, practical counsel, compliance partners, fund administrators that understand your obligations but also your business so that you
And
can
you're actually
grow
not
and
scary to
scale.
talk to. You make it
Yeah.
easy to talk to. You always have a smile on your face, so it makes it very
Right.
easy to work with you and refer clients back and forth.
Thank you so much, Eric. I really appreciate that.
You're welcome. Enjoy the holidays. I'm sure I won't talk to you before then.
Sounds good. Thank you. Same
Yeah.
to you.
Bye, everyone. Thank you for joining.